The financial markets stand at an extraordinary crossroads in this final month of 2025, a moment that will likely be remembered not for the euphoria coursing through trading floors and echoing across financial media, but for what comes after. The numbers tell a story of unprecedented exuberance. The S&P 500 hovers near 6,900, the Dow Jones approaches 48,000, and the Nasdaq continues to shatter records with metronomic regularity. Analysts project further gains. The Federal Reserve signals accommodation. Investor sentiment registers levels of confidence rarely witnessed in modern financial history. Yet beneath this surface of prosperity, beneath the champagne toasts and record bonuses, a different narrative emerges when we examine the structural foundations supporting these valuations. It is a narrative not of conspiracy or inevitable doom, but of cycles, of excess, and of the fundamental economic forces that have governed market behavior across centuries of capitalist development. To understand the present moment requires a journey backward through time, not to predict the future with false certainty, but to recognize patterns that have repeated with remarkable consistency throughout financial history. Every generation believes itself uniquely sophisticated, that technology or innovation or new paradigms have rendered obsolete the lessons written in the ledgers of previous eras. The bankers of 1929 believed the same. So did the mortgage traders of 2007. What connects these moments is not identical circumstances, but similar psychological and structural conditions. Valuations divorced from underlying economic reality. Leverage amplifying both gains and eventual losses, and the collective conviction that this time represents something fundamentally different. Consider the metric known as the Buffett indicator, the ratio of total stock market capitalization to gross domestic product. This measurement, favored by one of history's most successful investors for its elegant simplicity, essentially asks whether the total value of all publicly traded companies bears reasonable relationship to the size of the economy those companies operate within. Throughout most of the 20th century, this ratio clustered around 100%. Meaning the market's total value roughly equaled the annual economic output of the nation. During periods of irrational exuberance, it exceeded this baseline. In the late 1990s, as internet fever gripped investors, the ratio reached 148% before the subsequent collapse erased trillions in wealth. Before the financial crisis of 2008, it had climbed to 105%. Today, it stands at 230%. Not slightly elevated, not moderately concerning, but at levels that dwarf every previous peak in recorded financial history. This represents more than a statistical curiosity. It reflects a fundamental disconnect between the productive capacity of the real economy and the expectations embedded in asset prices. When investors collectively value companies at more than twice the total output of the economy in which they operate, they are pricing in assumptions about future growth and profitability that may prove difficult to achieve. They are, in essence, borrowing returns from the future, pulling tomorrow's gains into today's prices. This creates a vulnerability, a fragility that requires everything to go right simply to justify current valuations, let alone support further appreciation. The Shiller-Cape ratio, named for Nobel laureate Robert Shiller, tells a complementary story. This metric examines the price-to-earnings ratio of the market, but smooths earnings over 10 years to account for the business cycle's natural fluctuations. Over the past century and a half, this ratio has averaged 17. It means, historically, investors paid $17 for every dollar of inflation-adjusted earnings. Before the dot-com collapse, it peaked at 44. Before the Great Depression, it reached similar heights. Before 2008, it stood at 27. Today, it registers 39. The mathematics here are straightforward. Investors are paying more than twice the historical norm for each dollar of corporate earnings. This premium might be justified if earnings were poised to surge dramatically. But corporate profit margins already stand near record levels. The scope for further expansion appears limited. What happens when valuations remain elevated while earnings growth slows or reverses? These valuation metrics capture the price paid for assets, but leverage determines the magnitude of the eventual adjustment. Margin debt, the money investors borrow to purchase securities, currently totals approximately $800 billion. Expressed as a percentage of GDP, it reaches levels witnessed only 3 times in the past century: 1929, 2000, and 2007. Each instance preceded devastating market crashes. The mechanism through which margin debt transforms market declines into cascades is well understood, but bears repeating. When markets rise, borrowed money amplifies gains. An investor with $50,000 who borrows another $50,000 can control $100,000 in stocks. If those stocks rise 20%, the investor gains $20,000 on a $50,000 investment, a 40% return. But this sword cuts both ways. When prices fall, brokers issue margin calls, demanding investors deposit additional funds or sell positions to reduce leverage. If the market declines 20%, that same investor faces a $20,000 loss on their $50,000 equity, potentially wiping out 40% of their capital. Forced selling to meet margin calls pushes prices lower, triggering additional margin calls, creating a self-reinforcing downward spiral. The corporate sector carries its own burden of debt, approximately $14 trillion, representing nearly 50% of GDP compared to a historical average around 35%. Much of this debt was issued between 2020 and 2021 when interest rates approached zero. Companies borrowed at 2 or 3% annual interest rates. Now those bonds are maturing, requiring refinancing at 5 or 6% or higher. The arithmetic is unforgiving. A corporation that issued $2 billion in debt at 3% paid $60 million annually in interest. Refinancing that same debt at 6% means $120 million in annual interest payments, an additional $60 million that must come from somewhere. Reduced investment, lower employment, diminished shareholder returns, or some combination thereof. Multiply this across thousands of companies, and the aggregate impact becomes macroeconomically significant. Commercial real estate presents perhaps the most visible manifestation of structural stress. Office vacancy rates in major cities hover between 20 and 30%, a consequence of remote work arrangements that persisted and expanded following the pandemic disruption. Property values have declined 40 to 60% from 2021 peaks in many markets. A building valued at $200 million 3 years ago might appraise at $100 million today, yet still carries a $150 million mortgage from more optimistic times. The property is underwater by $50 million. Approximately $1.5 trillion in commercial real estate loans mature between now and 2027. Banks holding these loans face an impossible choice: extend and pretend, hoping values recover, or recognize losses that could exceed their capital reserves. History suggests the latter becomes inevitable when the scale of losses reaches critical mass. Regional banks, repositories of much of this commercial real estate debt, demonstrated their vulnerability in the spring of 2023, when Silicon Valley Bank, Signature Bank, and First Republic collapsed within weeks of each other. Those failures resulted not from fraud or mismanagement in the traditional sense, but from the fundamental mismatch between assets and liabilities when interest rates rise rapidly. Banks borrow short and lend long. They take deposits that can be withdrawn on demand and invest them in longer-term assets. When short-term rates rise faster than the yields on existing long-term assets, the entire model comes under pressure. The bailouts and emergency measures implemented then stabilized the immediate crisis, but did nothing to resolve the underlying problem. Regional banks still hold $1.3 trillion in commercial real estate loans, many of which are deteriorating. When these losses can no longer be deferred or disguised, capital will be wiped out and the cycle of runs and failures will resume. The consumer, upon whose spending the American economy ultimately depends, shows signs of exhaustion. Total household debt approaches $18 trillion. Credit card balances exceed $1.2 trillion at interest rates, averaging 22%. Auto loans total $1.6 trillion. Student loans persist at $1.77 trillion. Delinquency rates are rising across categories. Credit card delinquencies increased from 2.1% in 2021 to 3.2% by late 2025. These are not yet crisis levels, but the trajectory matters. Over-leveraged consumers cannot sustain spending growth. Lenders respond by tightening credit standards. Consumption slows, revenues disappoint, earnings decline, valuations adjust. The household savings rate tells a related story. During the pandemic, as government transfers flowed and spending opportunities contracted, the savings rate spiked to 16%. By late 2025, it has collapsed to 4%, well below the 9% historical average. American households have depleted the cushion that might otherwise allow them to weather economic disruption without immediately defaulting on obligations or slashing spending. When unemployment rises or hours are cut, there are no reserves to draw upon. The adjustment becomes immediate and severe. Unemployment itself has begun to rise. From 3.4% in early 2023 to 4.5% by late 2025. An increase of 1.1 percentage points may seem modest, but the Sahm rule and empirical regularity identified by economist Claudia Sahm observes that when the 3-month moving average of the unemployment rate rises half a percentage point above its low over the previous 12 months, the economy has always entered recession. This threshold was crossed months ago. The Sahm rule has predicted every recession since 1970 with 0 false positives. It is not a theory requiring complex modeling. It is a pattern observed across half a century of data. Yet markets remain near all-time highs, seemingly oblivious to what this leading indicator suggests. Manufacturing activity, measured by the ISM Manufacturing Index, has contracted for most months since early 2023, registering below the 50 threshold that separates expansion from contraction. Manufacturing recessions typically precede broader economic downturns by 6 to 12 months. This indicator does not suggest recession is coming. It suggests recession has already begun in a crucial sector of the economy, and the effects are working their way through the system toward the service sector and consumption that have thus far remained relatively resilient. The Conference Board's index of leading economic indicators, designed specifically to forecast turning points in the business cycle, declined for over 20 consecutive months through late 2025. This represents the longest sustained decline since 2007 and 2008. By design, these indicators lead the economy by 6 to 12 months. 20 months of consecutive decline does not whisper of potential trouble ahead. It screams of imminent and significant economic contraction. Yet once again, markets appear disconnected from what these forward-looking measures suggest. The Federal Reserve finds itself in an impossible position, trapped between conflicting imperatives. After raising rates from near 0 to 5.5% to combat inflation, they have begun cutting back toward 4.5% by late 2025. But the path forward offers no easy choices. Cut rates too quickly or too far, and inflation, which has moderated but not disappeared, could reignite. Maintain elevated rates, and the weight of debt service, the stress on over-leveraged borrowers, the pressure on asset prices, all intensify until something breaks. The Fed is not choosing whether to prevent pain. They are managing the timing and perhaps the distribution of inevitable adjustments. Geopolitical tensions add another layer of uncertainty. US-China relations remain strained over Taiwan and technology. The Ukraine conflict continues without resolution. Middle Eastern instability persists. Any of these could escalate into shocks that cascade through interconnected financial systems. In a robust economy with reasonable valuations and limited leverage, such shocks might be absorbed with limited contagion. In a fragile system characterized by record valuations and extreme debt levels, any meaningful shock could serve as the trigger that transforms latent vulnerabilities into realized losses. Perhaps most remarkably, the current bull market that began in March of 2009 has now persisted for 16 years. Historical expansion cycles typically last 5 to 7 years. The longest previous expansion, during the 1990s, reached 10 years before ending with the dot-com crash. The current cycle has exceeded that by 50%. We are approximately 6 years past the historical average duration. This does not mean the market must crash immediately by some iron law of nature, but it does mean we are operating in unprecedented territory, where the assumptions that guided previous cycles may no longer apply, and where the eventual adjustment, when it comes, may be proportionally larger. None of this constitutes a guarantee or a precise prediction of timing. Financial markets are complex adaptive systems influenced by countless variables, many of which remain unknowable until after the fact. The purpose of examining these indicators is not to claim prophetic knowledge, but to assess risk and vulnerability. Each metric discussed represents not an isolated concern, but part of an interconnected web of financial and economic relationships. Extreme valuations would be concerning on their own. Combined with record leverage, deteriorating credit quality, structural stresses in commercial real estate and regional banking, exhausted consumers, contracting manufacturing, declining leading indicators, and a Federal Reserve with limited room to maneuver. They paint a picture not of inevitable doom on a specific date, but of a system characterized by fragility rather than resilience. The historical pattern is consistent across centuries of capitalist development. Periods of expansion and rising asset prices create incentives for increased risk-taking and leverage. Success breeds confidence. Confidence breeds complacency. Valuations detach from fundamentals. Leverage amplifies both gains and eventual losses. Some catalyst, often unpredictable in advance, triggers an initial decline. Margin calls and forced selling accelerate the decline. Credit tightens, economic activity slows, earnings disappoint, valuations adjust sharply downward. The cycle, which seemed permanent during the expansion, reverses with surprising speed during the contraction. The question facing investors and citizens today is not whether to panic or to celebrate, but how to think clearly about risk in an environment where many traditional signposts suggest caution, while market prices suggest continued optimism. The tools for navigating such environments have not changed fundamentally across generations. Diversification, liquidity, avoiding excessive leverage, maintaining perspective across market cycles, and recognizing that, while timing exact market turns is impossible, assessing relative risk is both possible and prudent. Looking ahead across the next 18 to 36 months, the probabilities suggest increased volatility and the potential for significant market adjustments. This is not a call to liquidate all holdings or to hide cash under mattresses. Actions that would themselves be forms of market timing unlikely to succeed. Rather, it is an acknowledgement that the structural conditions present today bear unsettling similarities to those that preceded previous major market disruptions. The valuations are more extreme. The leverage is comparable. The duration of the expansion is unprecedented. The macroeconomic indicators are flashing warnings. The geopolitical environment is uncertain. What remains unknown is the catalyst and the precise timing. It might be a geopolitical shock, an unexpected policy error, a major corporate bankruptcy, a series of regional bank failures, or simply the weight of accumulated excess that becomes unsustainable. The market does not require a single dramatic cause to reverse. Sometimes, the expansion simply exhausts itself, like a wave that has traveled as far as its initial energy will carry it before gravity reasserts itself. The prudent response is not fear, but preparation, not panic, but perspective. Understanding that cycles exist, that expansions do not continue indefinitely, that valuations eventually reconnect with underlying economic reality, allows for measured responses rather than reactive decisions made in the heat of declining markets. Those who study financial history recognize that the greatest opportunities often emerge from the greatest disruptions, but only for those who maintained the resources and the composure to act when others were capitulating. We stand today at what may be remembered as one of those inflection points where confidence was highest just before the turn. The next 18 months will reveal whether the optimism embedded in current prices proves justified, or whether the warnings flashing across numerous indicators were, as they have been in the past, harbingers of adjustments that seemed impossible until they became inevitable. Capital has its chronicles, stories written across centuries in the language of prices and cycles, booms and busts, expansion and contraction. Those who forget these stories are destined to repeat them. Those who remember them navigate with greater awareness of both the opportunities and the risks inherent in markets that are, ultimately, human creations, reflecting human psychology in all its complexity.